Most people think their 401k just sits there waiting for them after 65, collecting dust like some retirement piggy bank. Wrong. At 65, the rules change completely, and if you're not prepared, you could end up paying thousands more in taxes than you need to. I'm going to walk you through exactly what happens to your money and what you need to do about it. Let's start with what actually changes when you hit 65. Your 401k doesn't automatically do anything on your birthday. There's no magical conversion or forced withdrawal just because you turned 65. But here's what does shift. You now have access to penalty-free withdrawals. If you've retired, Medicare becomes available, which affects your healthcare planning. And most importantly, you're getting closer to required minimum distributions. That last one is the killer that catches people off guard. You've probably heard about required minimum distributions, or RMDs. Right now, if you're not yet 73, you're in the clear. But once you hit 73, the IRS forces you to start pulling money out of your 401k whether you want to or not. They've been patient, letting your money grow tax-deferred for decades, and now they want their cut. The government isn't running a charity here. Here's the calculation that matters. Your RMD amount is based on your account balance and your life expectancy according to IRS tables. Let's say you've got $500,000 in your 401k at age 73. The IRS is going to make you withdraw roughly $18,868 that year. That money gets added straight to your taxable income. If you don't take it, they hit you with a 25% penalty on whatever you should have withdrawn. Miss a $20,000 RMD, that's a $5,000 penalty just gone. But we're getting ahead of ourselves. You're 65, not 73, which means you've got an 8-year window. This is actually your golden opportunity, and most people waste it completely. Think about your income in retirement. You've probably got Social Security coming in, maybe a pension if you're lucky, perhaps some rental income or part-time work. Now imagine dumping an extra $20,000 or $30,000 of forced 401k withdrawals on top of that. Your tax bracket just jumped, and suddenly you're paying way more tax on every dollar than you needed to. The strategy that makes sense for a lot of people is starting partial conversions to a Roth IRA. Here's why this works. When you convert traditional 401k money to a Roth, you pay taxes on that conversion in the year you do it. Sounds painful, right? But if you're doing this at 65, 66, 67, before Social Security and RMDs kick in, you might be in the lowest tax bracket you'll see for the rest of your life. You're controlling when and how much you pay in taxes instead of letting the IRS control it for you later. Let me give you a real scenario. Say you retire at 65 with $600,000 in your 401k. You're living off savings and maybe a small pension, keeping your taxable income low. Instead of just letting that 401k sit there, you convert $50,000 a year to a Roth. You pay taxes on it now, probably at the 12 or 22% bracket. Fast forward to age 73. That $600,000 could have grown to $850,000. Now your RMD is roughly $32,000 per year, stacked on top of Social Security, pushing you into a higher bracket. See the problem? The Roth conversion strategy isn't right for everyone. If you're still working at 65 and pulling a solid income, conversions might push you into an even higher bracket. If you've got significant other income sources, same issue. And if you think you'll be in a lower bracket in retirement than you are now, it might not make sense. But for many people, those years between 65 and 73 are the sweet spot. There's another angle here that people miss. What if you're still working at 65? If you're still employed and participating in your current employer's 401k plan, you can delay RMDs on that specific 401k. Notice I said that specific 401k. If you've got old 401k accounts from previous employers, those still have RMDs, starting at 73. This is where rolling old 401ks into your current employer's plan can actually help you, assuming your plan allows it. and you're still working past 73. Your 401k after 65 also intersects with Medicare in ways you need to understand. Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. Big Four, 01k withdrawals, or Roth conversions can trigger higher Medicare premiums down the road. We're talking about income-related monthly adjustment amounts, or IRMAA. Cross certain income thresholds and your Medicare premium jumps significantly. So you're juggling multiple moving pieces here. You've got 8 years until forced withdrawals begin. You've got tax bracket management to consider. You've got Medicare premium calculations lurking in the background. And you've got the growth of your account working either for you or against you depending on how you plan. The biggest mistake I see is people doing nothing. They hit 65, retire, and just let everything sit. Then 73 rolls around and suddenly they're forced into decisions they're not prepared for, paying more in taxes than they ever needed to, and watching their Medicare premiums spike because of income they were forced to take. What you do between 65 and 73 sets up the rest of your retirement. The question isn't just what happens to your 401k after 65. It's what are you going to make happen with it? So what's the actual game plan? Let's break this down into something you can actually use. First, audit where you stand right now. Pull up your 401k balance, any other retirement accounts, Social Security estimates, and map out what your income looks like today versus what it'll look like at 73. You need to see the full picture before you make any moves. Most people skip this step and just react to whatever their buddy at the golf course told them to do. Don't be that person. Next, run the numbers on Roth conversions. Not just whether to do them, but how much and when. There's a massive difference between converting 30,000 versus 80,000 in a single year. You're trying to fill up the lower tax brackets without spilling over into the next one. Think of it like pouring water into a glass. You want it full, not overflowing. A tax professional can model this out for you, showing exactly how much you can convert each year while staying in your target bracket. Here's where it gets interesting. Some people use what's called a Roth conversion ladder. You're systematically converting chunks of your traditional 401k to a Roth IRA over multiple years, controlling your tax hit while shrinking that future RMD bomb. Others might do larger conversions in years when their income dips, maybe a year when they're between jobs or had a business loss. The strategy isn't one size fits all. What about just spending from your 401k instead of converting it? Absolutely valid approach. If you need the money to live on, withdrawing it strategically can accomplish the same goal as conversions. You're reducing the balance, managing your tax bracket, and setting yourself up for smaller RMDs later. The difference is, you're using the money now instead of moving it to a Roth for later. Both paths work, it just depends on your cash flow needs. Now let's talk about the stuff that complicates this. Pensions, rental income, part-time work, investment income. All of it stacks on top of each other when calculating your tax situation. If you've got a pension kicking in at 65 that covers most of your living expenses, your 401k withdrawal strategy looks completely different than someone with no pension. Same goes if you're collecting rental income from properties. Every dollar of income changes the math. State taxes matter too. Some states don't tax retirement income at all. Others tax everything, including Social Security. If you're in a state with high income taxes now, but planning to move to a no income tax state later, that changes when you might want to do conversions. You might wait until after the move to convert, paying 0 state tax on the conversion. Location isn't just about weather and cost of living anymore. Here's a scenario most people don't consider. What if you want to leave money to your kids? The Secure Act changed inherited IRA rules dramatically. Your kids now have to drain an inherited traditional IRA within 10 years, potentially at their highest earning years when their tax brackets are sky high. But inherited Roth IRAs still have to be drained in 10 years, but all those withdrawals are tax-free. Converting to Roth isn't just about your taxes. It's about the tax efficiency of your legacy. Let's address the elephant in the room. What if tax rates go up in the future? Nobody knows what tax policy will look like in 10 or 20 years, but we do know current rates are historically low and set to expire in 2025, unless Congress acts. If rates climb, paying taxes now through conversions or withdrawals starts looking smarter. You're locking in today's rates instead of gambling on tomorrow's. One more critical piece. Health savings accounts pair beautifully with this strategy if you're still eligible. Between 65 and when you enroll in Medicare, if you've got a high deductible health plan, you can contribute to an HSA. That money grows tax-free and comes out tax-free for medical expenses. It's like a stealth Roth account that doesn't count against you for Medicare IRMAA calculations. Once you're on Medicare, you can't contribute anymore, but you can still use everything you've accumulated. The years between 65 and 73 represent your last chance to take control before the government forces your hand. You're either going to be proactive now or reactive later. Proactive means lower lifetime taxes, controlled Medicare premiums, flexibility in retirement, and potentially a better legacy for your heirs. Reactive means surprise tax bills, reduced Social Security benefits due to taxation, higher Medicare costs, and watching more of your money go to the IRS than necessary. This isn't about perfection. You're not going to nail every decision and predict every variable, but you can absolutely set yourself up better than most people simply by acknowledging these years matter and taking deliberate action. Map your income, understand your brackets, consider conversions or strategic withdrawals, and factor in Medicare implications. That puts you miles ahead of doing nothing and hoping it works out. Your 401k after 65 is either a ticking tax bomb or a strategic asset. Which one it becomes is entirely up to what you do right now. So where does that leave you? You've got this 8-year runway between 65 and 73, and what you do with it determines whether you keep more of your money or hand it over to the IRS. This isn't about exotic strategies or complicated financial products. It's about understanding that doing nothing is actually making a choice, and it's usually the worst one. Look at your numbers, figure out your brackets, and decide whether conversions, withdrawals, or some combination makes sense for your situation. The people who win in retirement aren't the ones with the biggest 401k balances at 65. They're the ones who manage those balances smartly so they keep more of what they've earned. You've spent decades building that account. Don't blow it in the final stretch by ignoring the rules of the game.